The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
With so many people living longer, the fear of outliving your money becomes a reality for many of us. Will I be a financial burden? Will I outlive my money? How will I be remembered? My name is Neil Himmelstein, president of Main Street Planning Group. Please contact me by visiting mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. I will introduce you to strategies that will guarantee you will not outlive your money, that can guarantee you will not be a burden on your loved ones. Through a collaborative approach, we will uncover solutions that offer tax-efficient strategies, lifetime income, and legacy planning, choice, organization, direction, and education. That is the code we stand behind. Contact mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. And listen to me every Friday at 3 p.m. as I host the Main Street Code for Financial Success, right here on 103.9 LI News Radio. Good afternoon. Welcome to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. I'm here every Friday, 3 o'clock. If you miss an episode, you can catch me on Spotify or Apple, or visit me at themainstreetcode.com. And when we talk about our code, we talk about choice, organization, direction, and education. And we help hundreds of advisors across the United States, whether they're insurance advisors, attorneys, CPAs, with insurance advice. We are an independent agency representing 30 different life insurance, annuity, disability, long-term care, and life settlement companies. And all these things are so important in your planning, and that's what we do. And in addition, you should have a team of financial professionals helping you. If you don't have your accountant and your attorney and your insurance professional speaking together, reach out to us and let us help put together a plan that works for you, because you need to have your own team for your own finances. And today we're very fortunate to have with us Tim Kennedy. Good morning, Tim.
Thanks for having me. It's good to be back.
Good to be back. Tim had his own show called, what was your show called?
My show was called It's Just a Mortgage.
What?
And I aired every Monday.
Right.
At 2, 3 o'clock, and I discussed, the premise of a reverse mortgage today as a tax-efficient retirement income tool.
Yep.
And dispelling the myth that it's last resort or last-ditch effort. The truth of the matter is, the math tells us a reverse mortgage is much more beneficial earlier in retirement.
Yeah, very interesting. So I was crunching some numbers the other day. Honestly, I think about things like this. So one of the things that we look for throughout our life is building our credit. It's so important to have good credit. And why do we want good credit? Well, good credit, and I watch my credit all the time. I know I'm like 300 points different than I was 10 years ago. I worked hard at getting my credit good, because what does credit do? As a businessman and as a person, when you have good credit, it gives you options. It gives you liquidity. It gives you good interest rates. It gives you all kinds of great things.
Well, even opening a business, starting a business, they're going to look at your credit. Even auto insurance, they look at your credit for auto insurance based on what your premium's going to be.
I just looked at my auto insurance and decreased my premium in half.
There you go.
Because I said, you know what? Let me look at my bills. So in order to have good income flow, you look at a couple things. You look at reducing your expenses, increasing your credit, this and that. Well, here we are, and we're at retirement. We're near retirement. We're over 62, okay? And we're thinking, okay, what if I want to buy a house for my kids? What if I want to buy a second house? What if I want to... It all depends on my credit and liquidity, right? So I'm thinking about this, and then I remember we had conversations about this reverse equity line that they
This
have.
reverse mortgage thing.
This reverse mortgage thing. And Tim introduced me to it. And one of the things he told me, which just finally clicked in. Sometimes you got to hear something 10 times before it clicks in. It finally clicked in. So if I can now, let's say my house is worth $1 million. Forget I'm over 62. How much liquidity can I get from a reverse line of credit right now?
Yeah, so the way the reverse mortgage works, it's based off of the age of the youngest borrower.
Okay.
the appraised value of the house,
Okay.
and the expected rate. So in your situation, if you were anywhere between 62 and 65 and owned a $1 million home, you would qualify for somewhere around 35%
35%.
loan to value. So I could lend you $350,000.
Okay, so rather than taking out $350,000 out of my house that's paid for, I'm going to do a line of credit.
Best kept secret out there, Neil.
Okay, so, and it's a reverse line because I don't want to pay the interest right away, and I'm old enough to do it. I know there's some costs involved for setting up the loan, but I'm not going to use the money right away.
So I have this conversation all day long with individuals, very affluent individuals that have money in the bank, that they may still be working, or they're getting a pretty decent Social Security check and a pension check, and they say, Tim, I got a free and clear house. I don't need a mortgage. I don't need a reverse mortgage. And I'll say, no, you're a prime candidate for a reverse mortgage, specifically for what you just mentioned.
So let me go a little further. So I take out that $350 line of credit, but I don't use the money right away.
Don't use it. Don't touch it.
Do I pay interest on it?
You're only paying interest on the money you're borrowing. So if it's on the line of credit, you're not paying interest on it.
Right, but this is what's amazing. Okay? Because if I don't touch it, and I leave... Now, why would I need liquidity? Well, listen, my kids are getting older. Kids can't buy houses today. First-time buyers. The average age it's now 40.
Especially on Long Island. I mean, look at the prices of these houses
Between
on Long
the
Island.
prices and the interest rate, it's very hard for young people to now buy houses. So a lot of people are helping their kids or whatever. But guess what? My kids aren't ready yet. Maybe in 10 years they're ready. But I don't need liquidity myself.
You're killing me, Neil. Get to the punchline.
The punchline is this. Okay, so I want to use that $350, but if I wait 5 years, what happens?
So with the reverse mortgage, and this is the best kept secret, Neil, is that line of credit has a guaranteed growth rate factor to it. So that $350,000,
right?
If you don't touch it, don't use it, it increases over time. So for example, in 10 years, you could very easily have an available line of credit of $700,000, tax-free money.
Stop right there. So I want to help my kids out, but all my money's tied up in pensions, everything. I'm living great. My house is paid for.
You have all this equity in the house. It's an illiquid asset.
And then if I go to cash in my 401k or IRA, I got to pay straight out income taxes, which will not only cost me a lot of money. So let's say I took out $350,000 in 10 years. I'd have to pay full tax, regular income tax. It'll screw up my Social Security tax, and my Medicare Part B will go from $190 today to $600. Okay, immediately.
You know what my favorite quote is, right? From Ed Slott.
No, what's that?
Even though we call him Uncle Sam, he's really not our uncle, and there's really no reason why we need to give him all our money.
Okay, well, you got it. So in that sense, I'm illiquid, even though I'm doing fine. But guess what? I talked to Tim 10 years ago, and now if I want to give my kids a couple $100,000 to buy a house or loan them the money for the house, rather than having to go to a bank because maybe their credit's not as good as my credit, or maybe their income is not there where they can get the credit.
And how about why not share a little bit of your legacy with your children while you're alive?
Exactly.
And watch them enjoy it.
So here I have this liquidity now where, I don't have to take out an application anymore. I already did that. I don't have to worry about it because I'm basing on... In the meantime, hopefully, my house is appreciated, yet there's no mortgage on it because it's a line of credit. It's over here.
Yep.
So my house is now worth maybe, hopefully, $2 million that it was worth 10 years ago. It's gone from $1 million to $2 million. And I don't partake in any of that interest. I'm not getting interest payments on that. However, I'm building up interest payments on my liquidity.
It's a pretty cool...
Do I understand this now?
It's a pretty cool buffer asset.
God,
right?
How many times you have to hit me in the head before I understand something? It's very
Neil,
crazy.
I'm pretty impressed that you formulated that pretty well, because we've been discussing this for how many years?
I understand,
but we haven't talked about it in quite some time. So that's pretty good. You did a good job.
But now I understand it. But I also understand it in legacy planning, where we have people. Well, long-term care is too expensive. Life insurance too. all this stuff is too expensive. But guess what? Now I have the liquidity to afford those things, to protect it. So now I can buy insurance and whatnot and pass that on tax-free to the kids. I'm going to tell you a little idea I have right after the break, because I'm running short. You're listening to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. Best way to reach me is 631-647-4694, or you can always visit me on my website, Tim Kennedy. How do they reach you?
They can reach me at 516-729-6040, 516-729-6040, or just go to the computer and type in Tim Talks Reverse.
I like that. Not only does he talk reverse, you're wearing your shirt backwards today. I'm just kidding. Okay, thank you. We'll be right back after a break.
You scared me, Neil.
Okay. Welcome back to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein, and today we have with us Tim Kennedy, a reverse mortgage specialist from Movement Mortgage. Say hi, Tim, again.
Good morning, Neil. Thanks for having me.
Oh, welcome back. Welcome back. And before the break, we were talking about how the equity of your house can grow and your credit line grows without you touching the equity. That's what I like. I'm not really touching the equity. I'm just holding it there for reserve and saving that.
It's a little bit like it's like a safety valve.
It's a big safety valve.
The big message I have to get out there, and what we do at Movement Mortgage as part of this reverse mortgage team is get the message out there that a reverse mortgage is no longer last resort, no longer last-ditch effort to keep mom and dad in the house. It's actually a pretty good tool in the toolbox when talking about retirement income planning, and exactly what you are talking about now is creating this buffer asset, this tax-free buffer asset.
Tax-free. Huge. So, and not only that, you don't have to apply. You don't have to go through the stress.
You still maintain home ownership. It's still your home. The bank or the government does not own your home. You're still in the deed.
You're just opening up that buffer to do things later. Now, the biggest issue people have in retirement, in legacy, especially as we get older and older and older, one asset that we have is we want to keep our house. I think the house is important. We want to stay in our house.
My wife and I love our house. Yeah.
Right. But you want to stay in your house. You don't want to be forced into a nursing home, maybe forced into moving with your kids, or you don't want to be forced into doing anything you don't want to do. So
you still want to maintain your independence.
Right.
And more importantly, maintain your financial independence.
Correct. And then sometimes the only asset people have at the end of the day, because they're getting Social Security, and I know a lot of widows like this, and they're sitting with a house that's paid for maybe.
Well, the stat is...
And a pension.
The stat is 65 to 70% of their net worth is tied up in the equity of their homes. Neil, there is over $14 trillion of home equity of individuals over the age of 62. $14 trillion.
Insane. So when you look at that, and you say, okay, now I'm older, I want to consider a legacy, even if I'm a widow and whatever it is, and I want to leave my kids the house. And maybe I have 3 kids. It's like the 3 bears, right? The last thing I want from my family is my kids to fight with one another, okay? And believe me, even if they get along today, when it comes to money, I've seen families
ripped apart
when it comes to money and inheritance and mine and yours. And even I see it with people that are still alive and they're not dead yet, but you got the kids feasting on them. Well, I should get this because of this, or well, mom's got money, let me take it now. And the other kids are taking care of them. I every day I see this.
I see it all day long, too.
And it's horrible. And it leads to... Nobody wants that. The other thing you see is they leave the house, and then one kid... And this every family, I don't know what it is. One kid's well off. He's doing fine. Well, you know what? I don't want to sell the house. Because if I sell the house, I'm going to lose all the... When's the worst time to sell? When you have to, right? So I don't want to sell it, so I split it up 3 ways. I mean, maybe I want to sell it next year, but I don't want to sell it right away. If I sell it, I'm not going to get the value. Whether I have a building, a house, or anything, the worst time to sell is when I have to and divide it up. That's horrible. So another kid, they want to live there. That's their family home. They don't want to see it go anywhere else, and they want to stay. And the third kid,
he's got kids in college and needs the money.
He needs the money. He needs the liquidity. I got to have the money right now. So what do you do? So one of the ways we're going to talk about, we talked about this reverse line of credit and this and that. One of the ways is to buy something called life insurance. And what that does is that gives you cash, which is easily dividable, right? Unlike a house or a building, the only thing that's dividable is cash. And the only way to have tax-free cash when a large sum is life insurance, which you have to pay for, but you don't have the liquidity to pay for it. So I've told you a way of creating liquidity for down the road, but you can create it immediately. So how do I create immediate liquidity without hitting my pensions, without hitting anything? And this reverse equity line, to me, is a fantastic idea. Now, there's another situation that happens, too. I want to stay in my home, and one of the things we talk about all the time is really long-term care, is if I can't perform my daily activities of daily living, I'm going to be forced into a situation where one of my kids has to move in, I got to pay for aides, or I get shuffled around. And what did we say at the beginning? I want to live in my house. I don't want to be shuffled around. Forget about nursing home. Nobody wants to go there.
Nope.
But I may not want to go to my kids in Arizona and go to their house. I want to stay home.
So let's get back to cash flow and liquidity.
Right.
Do you know homeowners over the age of 65 approaching retirement, over 50% of them are going into retirement with a mortgage payment?
Right.
So following your thought process is, let's take out a reverse mortgage. Let's eliminate that mortgage payment. Let's use that mortgage payment to do something else, possibly a life insurance policy or a long-term care policy, or if there is no mortgage on the property, let's create that line of credit and then possibly use the line of credit to support what you want to do.
Right. So if I'm only using $10,000 of line of credit a year, I have a $350,000. We're going to go back to our original example, $350,000 line of credit, but I'm only going to use $10,000, and I'm going to buy insurance that's going to replace my loan amount, which is $350,000. Plus, with some of these new policies, I can get long-term care protection so that if I become need some sort of care, I have a pocket of money to pay for that. What I love is these hybrid policies. Honestly, Life with long-term care fits in beautifully here, because the cost of me needing care here in Long Island, or cost of me hiring an aide for 24 hours or going into a nursing home, it's over $500 a day now.
It's big money. It's big money. Yeah.
It's money that will drain my estate. My kids will get nothing. And it also gives me the freedom to hire people to take care of me. So one of the ways is to create that liquidity so that I have that protection so my kids can still get the house. That's what's unbelievable.
But Neil, what's happening?
They get the house. They get the insurance, and God forbid I get sick, I've got a policy that's going to cover me so that it doesn't deplete any of these assets that I have.
But you also still have all your other money in bucket number 2, right? Your stocks, your bonds, your IRAs, your 401ks, your Roth. You have all that other money still growing.
Right.
So, we talk about that all the time. Everybody thinks this reverse mortgage is going to eat up the equity in the house and it's going to leave nothing to the children. The truth of the matter is, if they do it right, what you're discussing, they will leave a bigger legacy to their children, to their heirs.
Absolutely. And the problem is with reverse mortgages in general and reverse equity lines is these people in the investment world who you think is your investment, is your chief advisor, because they manage maybe your 401k or they manage your stocks and bonds, and you think they know everything, they're going to say, there's two things they say. A, they're not allowed to talk about reverse mortgages.
Which is not true, by the way.
Well, a lot of the broker-dealers prohibit them because they're afraid of registration.
Hey, Neil, I know we'll wrap it up here, but I have a book for you, The Guru Gap.
Oh, thank you.
So it talks a lot about Dave Ramsey and Susan Orman not necessarily giving out the correct information, right? For the most part, but talking about everything we've discussed today, other avenues of protecting and preserving our retirement year. So this is for you. Enjoy it.
I appreciate
and maybe next
that.
time we can talk about it on, if you invite me back, we can talk it on your next show.
I'd love to, Tim. Anyhow, you've been listening to the Main Street Code for Financial Success. Tim, how do they get a hold of you if they want to speak to you?
If they want to reach me, they can call me at 516-729-6040, 516-729-6040, or they can reach me on the computer at timtalksreverse.com.
And if you want to reach me, it's 631-647-4694. Visit me at themainstreetcode.com. Thank you very much. Have a great holiday. And Tim, thank you for coming here, and thank you for the book. I appreciate it.
Thank you for inviting me, and enjoy your Thanksgiving. Enjoy your family. We have a lot to be grateful for.
Yep.
A lot to be grateful for. So thank you.
Thank you.
The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.